Hello, scholars, and welcome to this lecture where we're going to talk about net present value and other investment decision criteria. I'm really excited about this one because this is actually what I did for my career at Procter & Gamble for about 6 years. So we'll start off with this quote by Sam Walton. It says, "Exceed your customers' expectations. Give them what they want and a little more." And that's exactly what comes to mind when I think of net present value is you're going beyond what's the minimum required return and you're trying to deliver more value than zero. So this is consistent with the idea of maximizing firm value and maximizing shareholder value. So we're going to learn net present value and a few other ones, but by far, in my opinion, net present value is the most important decision criteria firms can use when evaluating capital budgeting criteria and projects. So here are some learning objectives, why we use NPV and why it's the best way to evaluate a proposed investment in capital budgeting. We're going to learn payback rule and its shortcomings, the internal rate of return criterion, including strengths and weaknesses, and then we'll talk about profitability index and how it relates to NPV. So we have a lot of criteria to talk about today, and we're going to use Marshall Farms throughout. So before we dive in, do a one-page review here on other concepts we've seen in corporate finance and see how this relates to capital budgeting and investment criteria. So corporate finance seeks to address the following three questions. First is, what long-term investment should the firm make? So when you think of long-term investment, think of your assets equal your liabilities and your equity. So we're focused on the left-hand side, but more specifically, your long-term assets. Assets that last more than 1 year, assets that need to be depreciated, plant, property, equipment, land, maybe amortized like a patent, something like that. So the first one is capital budgeting, and that's the decision of what long-term assets should firms invest in, and that is capital budgeting. Second, how will they finance it? That's the right-hand side of this. Is it going to come from debt or equity? How are we going to finance it? That is capital structure. There's a whole unit on that, an entire chapter on capital structure, on whether we should issue debt or issue equity or use previously saved funds for that. And lastly, how to manage the day-to-day financial activities of the firm. I think of that as your current assets and your current liabilities. Think of that as working capital. Think of those as, remember that, net working capital, or your current assets less your current liabilities. This is working capital is your last one. So three things the corporate finance manager does: capital budgeting, capital structure, and working capital. And again, we are concerned about making decisions and firm value. A lot of this math is fun, but we do it ultimately to make a decision that creates firm value. And our focus is on cash, not on profit. So a financial manager's objective is to make decisions that generate value for stockholders by generating more cash inflows than outflows. And there's two different definitions I want to cover with DCF for you, and they're pretty much synonymous. The first one is DCF is the process of calculating the present value of a future cash flow to determine its value. And you could think of it as the value today. We're making decisions today, so we need to determine how much it's worth today. Also, the process of valuing an investment by discounting future cash flow. So both the same thing. And this is synonymous. Don't forget that our goal here is to maximize shareholder value. So we need to keep that in mind when we're deciding on certain projects. You could think of that as maximizing the current value per share of existing stock. Don't get that confused with price. They're not always synonymous. The value of a stock is the value of the owner's equity. Therefore, to maximize the market value of existing equity is our goal. Calvin, your mother and I have decided to give you an allowance. It's important one learns the value of money. Money, ha 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 ha. I'm rich. I can buy off anyone. The world is mine. Power, friends, prestige. I can buy it all. I'm free. Ha ha ha. I blew it again, dear. I love that comic. There's not too much where you see value of money in a comic. So when I saw this one, I had to share it with you. All right, valuation. Let's recall this famous quote, one of my favorite ones by Warren Buffett. There are only two variables you have to plug in to value any financial asset. The financial asset here is capital, and capital is a long-term asset, right? It's an asset that lasts more than 1 year. We call it capital. So this process of using these investment decision criteria is on a capital budgeting project. So the investment asset is a long-term asset. That's simply the stream of cash in, which we call after-tax incremental cash flows, and out, or the initial outlay and investment between now and judgment day, or the project life, discounted at the proper rate of interest, known as a project's cost of capital, or sometimes you just hear it called a discount rate. Here are 3 tools and rules I'm going to share with you. Let's first start with the most important one, net present value, or NPV, the present value of an investment's cash inflows or its benefits minus the present value of its cash outflows or its costs. So there's 3 different equations here I want to show you, but just try to think of them all as the same. Net present value is equal to the initial outlay. I'll circle that in red because that's typically an outflow, an investment. And then the present value of these uneven future cash flows. And there's cash flow 1, cash flow 2, all the way to cash flow N, or however many years you have. And if they're conventional cash flows, it follows the pattern that it's an outflow, negative, followed by a series of inflows. And the reason I put CF1, CF2, CFN, etc., is to just show that those cash flows are uneven. They're not repetitive. They're not an annuity necessarily. You could also think of net present value as just the sum of the future cash flows. We expect these to be positive, less the initial outlay. And that one doesn't need to be discounted because it's an investment choice we're making today to invest those funds. So this is the same thing as just saying, take the present value of the benefits, your cash inflows, less the present value of your costs or that initial investment. So that's the tool. That's the net present value tool. Now the rule is invest if the net present value is greater than 0. Typically, you include equal to 0 in there as well. So you invest or you accept the project if net present value is positive. However, if net present value is negative, you do not invest. So that would decrease firm value if you accepted projects that had a negative NPV. So accept positive NPV projects. That's consistent with what we're trying to do here in maximizing firm value and maximizing shareholder value. The next tool we're going to learn about is the internal rate of return. And I want you first to notice the similarity in the equations between net present value and internal rate of return. Key difference here, look at NPV. NPV is now 0. So the internal rate of return is the discount rate that makes the net present value equal to 0. It's the discount rate that equates an investment's costs or its outflows equal to the present value of an investment's inflows. So that last sentence there relates here. You could put this as present value of the benefits equal the present value of the costs. So they're equal. The other key change you want to see here between these equations is R. So we're not talking about a cost of capital anymore, but now we're talking about an internal rate of return. So the internal rate of return is the discount rate that makes the net present value 0. So if you see the definition here in words, and then try to relate that to the equation you have for net present value and the equation we have for internal rate of return. But that's the discount rate that makes net present value equal to 0. You could think of that as a project's return, if you will. That's the tool. So that's the tool. The rule, so if a company actually uses this tool to make decisions, we say the rule they follow, the decision rule that is that they invest in the project if the internal rate of return exceeds some required rate of return or some minimum cost of capital or some hurdle rate. So the IRR needs to exceed that. Maybe they're looking for a required return of 15%, so an IRR of 25% is more than they're looking for. If they use the internal rate of return rule, then that's the criteria they would use to follow. So they invest only when the IRR exceeds the hurdle or required return or the minimum cost of capital. And the last one we'll talk about here is the payback period. The payback period is measured as a measure of time. In fact, it's the number of years required to recover the original investment in a project. So there's no easy way to put a decision rule on this one. We had a decision rule for NPV, which was to invest when NPV is greater than 0. The decision rule for IRR was to invest when the IRR exceeds a required return or a minimum return. But the payback rule, there's an arbitrary threshold that a firm sets up. They set up and they say, we want to get paid back within 5 years. So you probably won't see this one if you work for a large corporation. You're going to see NPV and IRR a lot more frequently by far. But if you work for a smaller company, you may see payback because it may not be as easy for them to get financing for their ideas. So they may want to focus on how long they have to wait until they can get their funds again before they can invest. Maybe you're thinking of building a bakery, so you got to pay for all the ovens and the store space. And that bakery can't just go out and issue bonds very easily. They can't go out and get shareholders very easily. So maybe they're going to measure a payback period to say we want our investment in the next bakery to pay back within 5 years, or 5 years is the amount of time they're thinking about growing. So if it's a smaller firm, you may see payback, but other than that, it's not used that widely. Marshall Farms, this is just an example. We're going to use these cash flows in several different instances, and we're going to use the three different criteria on these cash flows. So cash flow 0, notice it's negative, it's an outflow, it's an investment. The next 3 cash flows are uneven, they're not the same, and they're all positive. So we're investing money and then we're making money there. So we're going to use those examples. But before we do, let's try this NPV definition. You could also think of net present value as a difference between an investment's market value and its cost. It's a widely used approach. It's probably this and IRR, the most commonly used decision criteria you'll see in capital budgeting. So they are the most important. And this is consistent with this idea that we are trying to maximize shareholder value. So using IRR is a great way to evaluate what investments you should make, what long-term investments the firm should buy. So if a project creates value for shareholders, the company should proceed with the project. That's the saying, a positive NPV project creates value for shareholders. We're following that rule that if NPV is greater than 0, if NPV is positive, that is, that we should invest in that project. How do you do this? Well, you estimate the expected future cash flows. You estimate a required rate of return. What's an appropriate level of risk to be compensated for in that project? And we'll talk about that more in future lectures. More risk of the project, then more required return or a higher rate you would expect. This is not related to the financing, though. So keep these 3 questions separate. When we are deciding what long-term assets to buy, that is, when we're deciding capital budgeting, we are ignoring the source of funds and focusing solely on the use of funds. So when we evaluate different ideas for these long-term assets, we have to discount them according to how risky those ideas are, not necessarily on what yield we issued the bonds at or what return the shareholders want. We are not doing that. We separate those 2 decisions. So you don't want to mix those up. So here we go. Here's another summary again. Positive NPV projects we're looking to accept. Negative NPV projects we reject. Let's look at Betty Lou's Bakery. She's evaluating a new oven to continue with this bakery theme. The oven requires an initial cash outlay of $19,000 and will generate after-tax cash flows of $4,000 per year for 8 years. Calculate the NPV of the project if the interest rate or your cost of capital is 10%. So your NPV is just that outlay. So it's just the 19,000 negative plus we have an annuity here. You could just discount each of these cash flows, 4,000 over 1 with the discount rate, cost of capital, to the 1 plus 4,000. 2 periods. Continue to do this. You could do this 8 times, but there's a much more straightforward approach, which I'll show you. 1 plus 10% is 1 spot 1, right? Because it's 1 plus 10%. We have to move that decimal on the 10% over 2 places so it looks like 1 spot 1 0. And that would be to the power of 8. So here what we could do is we could actually go cash flow, second clear work, 0 those out. This is your cash flow 0. Cash flow 0 is 19,000. Make sure you get the direction of that correct. In the lower row here, you have this plus minus. You can set that equal to negative 19,000. Enter. Scroll down. Cash flow 1 is 4,000. Enter, down, and keep that frequency at 8. So you're just saying you have an initial outlay. Let's go back to cash flows. An outlay of 19,000, negative 19,000. First stream of cash flow or first pattern of cash flow shown there is 4,000. Scroll down, it has a frequency of 8 times. So then all you need to do is compute net present value Our cost of capital is our interest rate. We gave the calculator timing and magnitude. Now it needs some proxy for risk, which is our cost of capital, and that's 10%. Your calculator knows that that's a percentage. So 10, enter, and then down, and then compute. So the net present value is $2,339. So think of that. That includes the outlay. That includes the initial. So if this is time zero, that includes the cost of the project. And then these cash flows from time one of 4,000, I'm just going to put dot, dot, dot. So you see that that repeats 8 periods. The net present value, the reason we call it net present value is because it's net of the investment today, and the present value of the future cash flow. So that's where the PV comes from. Net because it includes the outflow, present value because it's the discounted value of all the others. So when you include all of these together, you have your net present value. So after you've accounted for the cost, you are now creating $2,000. That's the value of this idea. Having this idea, you just create it almost out of thin air, $2,000. Maybe you think that's small, just add 3 more zeros onto it. It's just different sizes for whatever firm you're working for. You could think of it as that's how much your idea is worth. You could sell this idea to someone for this amount. So these are criteria we use to ask ourselves if the criteria, the decision criteria, is actually good or not. So the 3 are, does the decision rule adjust for the time value of money? And in our case, it does. This later cash flow of 4,000 that happened 8 years from now was discounted 8 periods. That makes its present value smaller than the cash flows that were received earlier on, like 1 or 2 years away. So the NPV criteria does adjust for time value of money. It does adjust for risk, and our proxy here for risk was our cost of capital at 10%. If it was a riskier project, maybe the cost of capital would have been 15 or 20%. So it does adjust for risk. And does it tell you whether you create value for the firm? And sure, it sure does. The NPV of this project is $2,339.70. So that's the amount of value created when the firm decides to accept this project. And they would accept it because the NPV is greater than 0. So that would lead to an accept decision using the IRR decision criteria. Let's apply this to Marshall Farms and see what this looks like. So we have the cash flow shown here, an initial cash outlay of 165,000, and then 3 years of inflows shown below. The required return, or your cost of capital, is 12%. You could think of that. That's the same thing as a discount rate. I know we use these terms interchangeably, but all of these are synonymous, meaning they mean the same thing. So formulaically, you have the outflow, no discounting on that one. So no reapplication of this formula. Future present value equals future value over 1 with r to the t. So t just being time, and then present value of all your inflows, discounted 1 period at the 12%, discounted 2 periods at the 12%, and discounted 3 periods at the 12%. So again, that's the formula we're reapplying in these 3 here. But your calculator does do the uneven cash flow approach. If you see these 3 together, cash flow, NPV, and IRR, all you have to do is enter cash flow. First thing to do before you start typing in there is just clear it. So go second, and then all the way at the bottom, clear work. That'll zero it out. You have 165,000 outflow, so negative, enter. And then cash flow 1, you just enter them year by year, 63,120, enter, scroll down. Leave the frequency of that at 1 because you get that cash flow only 1 time. And then your next cash flow is 70,800. Enter, down. Again, frequency is 1. You get that 1 time. And then your last cash flow is $91,080. Enter. So then compute net present value. We gave it timing and magnitude. We now need risk. So this risk level is at 12%, our cost of capital. 12, enter, down, and then compute. This project, we should accept. The NPV is greater than 0. Even after evaluating for the initial cost of 165,000, this project creates $12,000 in value. So we should accept this. And then we just make sure, you know, we talked about this a little bit before, but this is a good decision criteria to use. Why? It adjusts for time value of money, it adjusts for risk, and it tells you and it actually gives you an exact measure of value creation for the project. So this is a phenomenal project. While we're here and we have these entered in already, I want to skip right down towards internal rate of return and show you internal rate of return. That's your discount rate that makes the net present value of an investment equal to zero. If you can't use NPV, IRR is the most important alternative. It's widely used in practice. It's intuitively appealing. People like to want to know what the rate of return their investment has. And if you use this decision tool, the rule is that you accept if investments when the IRR is greater than the required return or the hurdle rate. So our required return up here for the last project was 12. So we already entered the cash flows in. So all you have to do is compute and then IRR and then press compute again. It's 16%. We required a return of 12. And this project exceeds that because it's earning 16%. So in this case, the required return of 12, we have a 16.13% IRR. That's a great return. So it exceeds the hurdle, it exceeds the threshold, the minimum threshold, and so we should accept that project. So what I've done here is shown you a net present value profile of the Marshall Farms cash flows at various discount rates. A net present value profile is a graphical representation of the relationship between an investment's NPVs and various discount rates. So look, if there's no discount rate, that's equivalent to just adding up all the cash flows. What we saw with a 12% discount rate, we saw an NPV right around here, right? Compute NPV, enter down compute, 12,000 right there. So at a discount rate, we are still positive. And in fact, at any discount rate less than the IRR, we are positive. Here is your IRR. It's where you cross the intercept. NPV is 0. That's your internal rate of return. And we said that that was 13%. So at any discount rate less than the internal rate of return, net present value is positive. All these rates are lower. And in fact, at low rates, value goes up. And we see that relationship a few times in finance. It's not certainly unique to this case. At discount rates or cost of capital higher than the internal rate of return, the NPV is negative. So if the discount rate of this project were actually 22%, we're saying it's a pretty risky project at a rate like that, then we would reject this project. It would have a negative NPV at a discount rate of 22%. Don't believe me? Let's try it out. So we go NPV, change that to 22, enter, down, and then compute. NPV is now negative 15,000. We'll compute the IRR. IRR doesn't change, right? The IRR is just based on what cash flows there are and what discount rate makes the NPV equal to 0. So the IRR did not change, and that's not surprising. So let's go back and talk about payback period a little bit. Payback is a measure of time. It's the amount of time required for an investment to generate cash flows sufficient to recover initial costs. How do you do this? You estimate the cash flows, subtract future cash flows from the initial cost until the initial investment has been recovered. So this equation is take the years before cost recovery, then add the remaining cost to recover over the cash flow during the next year. I think it's easier to use an example on this one. So here are our cash flows for the project. You know, we initially invested 165,000. So that's the amount that we have to recover. So we're talking about how long, how many years does it take to recover the 165,000? Well, my year one cash flow is 63,120. So if I have 165 to recover, and in my first year I make 63,000, I subtract the 63,000 from the 165,000, and now I have 101,880 remaining to recover. So after 1 year, so it takes at least 1 year, I still have 101,000 remaining to recover. In the second year, I make 70,000. So I take 70,000 and subtract that from the 101,880, and you see I have 31,080 to recover. So it took at least 2 years now, and I still haven't recovered it all. But at this case, we have 31,000 remaining to recover, and my third year's cash flow are 91,000. So the process now is to take that first year, add it to the second year, so we have 2 years of recovery now, plus a fraction of a year, and we have this much to recover. And then in the third year, we make 91,000. So it's about a third of a year. You take the remaining cost to recover and divide it by the cash flow during the year. And you would do this until this numerator is a lower number than the cash flow you're making the next year. So in this case, we have a payback period of 234 years. However, the rule Marshall Farms came up with is they want to pay back within 2 years. So based on the payback rule, they actually would have rejected this project. So remember, the three decision criteria we've talked about are NPV, IRR, and payback. NPV said we should accept this project. IRR said we should accept this project, but when we use payback, it said we should reject it. So is this a good criteria? And in fact, it highlights red on all of these elements. It does not adjust for time value of money. It does not adjust for risk. And it does not tell you whether you create value for the firm. Why is it used? People like to know when they get paid back. And like I said, maybe the company is cash strapped, or maybe they can't get good financing. So maybe they use payback period. It's not an efficient criteria to pay back with. It's not a good decision criteria to use. Focus on NPV or focus on IRR, but NPV for sure. Why do people use it? It's relatively easy to understand. It adjusts for uncertainty of later cash flows. However, it is biased towards more liquid investments. Big disadvantage here is that it ignores time value of money, arguably the most important concept in finance. This arbitrary cutoff period, Marshall Farms, it was a 2-year cutoff. Why not 3? And it ignores any cash flows beyond the cutoff date. So if there was a massive cash flow happening in year 4, it would just miss out on it. Let's try an example here. Willy Wonka is considering an expansion project that requires an initial cash outlay of $50 million that will generate cash flows of $18 million in year 1, $22 million in year 2, $25 in 3, $30 in 4, $32 in 5. Calculate the payback period if the cost of capital is 8. Well, with payback period, we don't actually need the cost of capital. So that was just thrown in there as a curveball for you. So here's how I would recommend setting these up. Just set up the 50 million to recover. So, and then all you have to do is go year 1, you have 50 million to recover, but in year 1, you make 18 million. So you do year 1's cash flow, your cash outflow of 50 million to recover, less the year 1 cash flow of 18 million. And you have 32 now to recover after 1 year. And maybe instead of recover, I should say to pay back. So in year 2, right, you have 32 now to start the year, but then you have 22. You make 22. So minus 22 equals now 10 to pay back. And then you have 25. So year 3, you have 10 to pay back, but look, your year 3 cash flow is actually 25 million. So all you need is it took 1 year plus 1 year and now a fraction of a year. So that's 10 over 25. So 2.4 years. And they have a maximum payback period threshold. They want to pay back within 2.67 years. This takes 2.4 years. So in this case, we would actually accept. Yes, accept the project using this decision criteria. Since it gave you the cost of capital, you could actually calculate the NPV as well. All right, so let's talk about IRR. Now, IRR, we went back and I did NPV first, then we looked at IRR. IRR is a good criteria too. It does adjust for time value of money, it does adjust for risk, and it does tell you whether you create value for the firm. It is intuitively appealing to know what a rate of return a project is. It's a convenient way to communicate the value of a project to someone who doesn't know all the estimation details. And I've never done this, but if the IRR is high enough, you may not need to estimate a required return, which is often a difficult task. But however, it does have a couple disadvantages, and one of them is with non-conventional cash flows. So conventional cash flows have one sign change, meaning it goes from negative to positive. You spend money, you make money. So there's one sign change. It goes from negative to positive. That's one change. However, if it goes from negative to positive and then back to negative, you have changed sign once there and you've changed sign twice here. Now you've changed sign twice. This is unconventional cash flows or non-conventional cash flows. This could get you into trouble. This IRR could mislead you in this instance because there could be more than one internal rate of return versus conventional cash flows. So that's one disadvantage. The other disadvantage is when there are mutually exclusive projects. When there are mutually exclusive projects, NPV is a superior decision criteria to use because although the rate of return may be higher on one, if the net present value is higher on the other one, it's a better deal because remember, our goal is maximizing shareholder value. At the end of the day, the shareholder wants to get paid in a dividend, actual cash flow, not necessarily a rate. So the one that delivers more value is the one we should choose, not necessarily the one that delivers the highest percentage return. So in a mutually exclusive investment choice, what does that mean? That's a situation where you can really only pick one if taking one investment prevents the taking of another. You pick one project or the other. We say they're mutually exclusive. You can go to one school, not both. So you choose either the U or FSU. You don't go to both. So if there's a conflict between NPV and IRR, always use net present value. That is a great criteria. It tells you the amount of value created with your idea. You could think of it as a really good idea if the NPV is high. It's just a measure of how good your idea is. IRR is unreliable, right? It has two weaknesses with non-conventional cash flows. So if they go from negative to positive, back to negative, or you have to pick one project or another mutually exclusive projects. All right, so let's take a look at these non-conventional cash flows, and I'll show you an example. When the cash flows change sign between positive and negative more than once, you have more than one IRR. So you're solving for the root of an equation, and then you're crossing the x-axis more than once. There's more than one return that would solve that equation. So if we show this net present value for these projects, look, we have an outflow initially, and then we have an outflow at the end, and the two in between here are inflows. So we have negative to positive, back to negative. That means we're crossing this intercept twice. So we have two IRRs. Your first IRR is here. Your second one is out here. So what do you do in a case like this? Well, if you added up all of these cash flows, you'd actually find that the NPV is negative at a 0% discount rate. So at any rate, any cost of capital between 0 and 10, NPV is negative. At any rate greater than 40%, NPV is negative. But between 10 and 42, NPV is positive. So in this range, you would actually want to accept the project in that range. So the question didn't tell you what decision criteria to use. It just said, suppose an investment will cost 90,000 initially and will generate the following cash flows. Should you accept or reject the project if the required return is 15? So these are non-conventional cash flows. You should use NPV. So if you use NPV on these and you discounted those cash flows at 15%, you'd see it has a positive net present value. So I'll show you that. Cash flow second, clear work. Cash flow 0 is 90,000. Outflow, enter. Cash flow 1 is 132,000. Enter. Cash flow 2 is 100,000. Cash flow 3 is 150,000. Outflow, enter, and then compute net present value at a discount rate, required return of 15, cost of capital. Your NPV is positive, right? Just under 2,000. However, let's look at if it asks this calculator to compute IRR, it's only going to give you the first IRR, which is the 10-11% here. It also has an IRR of 42%. So you have this multiple IRR problem. What do you do about it? Use NPV to make your decision. What's your required return? Use NPV to make a decision. Multiple rates of return is just a scenario when there's more than one discount rate. Again, discount rate is the same as required return or cost of capital here. More than one discount rate will make the NPV of an investment 0. All right, let's look at mutually exclusive projects. There's 2 projects here, Project A and Project B, creatively named. Which one should we accept if they're mutually exclusive? I'll just separate this so we can see our decision criteria or rules here. Well, Project B returns a higher rate of return, but Project A delivers more value. So Project A is the correct choice. If you thought Project A, it is Project A because it has a higher net present value. This project creates more value than Project B. So we should accept Project A if they're mutually exclusive. And it does say we have limited capital. So maybe we only have 500 million. So we can either pick to invest in Project A or in Project B. How do you calculate the crossover point? Well, I'll give you a hint. I've graphed both net present value profiles for Project A and Project B in the chart below. And what we're going to do is just take a look. They have no difference at the crossover point. They have the same NPV at this point. So think if you just subtracted one curve from the other curve, or one line from the other line A minus line B, at this point they'd have a difference of about, what, 20? And then it would scroll down until they have a difference of about 0, and so forth. So if you took the differences in those lines, well, then they'd cross this intercept around here where they have a 0 NPV. Said another way, you create a new project called A less B, and you just calculate what would these cash flows be. That's one way of thinking of subtracting one line from another and computing the IRR of the differences of those cash flows. So 500 minus 400 is what? So that's minus 100. Come on. If you're not sure how to do this, just do A less B, create a new column here, do 500. Whoops, let's get out of here. 500 negative minus 400 negative. Negative 100. You have 325 minus 325 gives you what? 0. 325 minus 200 gives you 125. So we just plot these cash flows by year. So period 0, 1, 2, 3. Go cash flow second, clear work. Cash flow 0 is 100, negative, enter. Cash flow 1 is 0, enter. Leave frequency at 1, and then cash flow 2 is 125, enter. And then compute for net present value. Sorry, compute for an internal rate of return, and you get your 11.8. So what do we do there? We're essentially just took the differences in cash flow by year and then plotted the NPV of those cash flows. So what was the step again? Just take a new column, Project A minus Project B, and then graph these or plot the NPV for cash flow 0, cash flow 1, cash flow 2, and then create a new cash flow column there. Negative 100, 0, 125, compute the IRR. That's the crossover point. At that point, both projects have the same NPV. So at any point less than this crossover point, project A dominates. A has a higher net present value than B, but then when they cross, Project B has a higher NPV than A. So in a high risk environment, you would accept project B. Low risk environment, you accept project A. Project B, take a look. You want to get paid back sooner in a high risk environment, right? Most of your cash flows are front loaded. Project B requires more, but you get paid back more later. So in a safe environment, you take project A. Risky environment, take project B. Profitability index is the last criteria we'll talk about. It's the present value of an investment's future cash flows divided by the initial cost. So it's not the net present value, it's the present value of a future cash flow divided by initial cost. So what is this? Why is this useful? Well, it measures benefit per unit cost based on time value of money. So a profitability index of 1.1 implies that for every $1 of investment, we create an additional 10 cents in value. Very useful to think of capital in this way. So how do you do this? How do you calculate the profitability index? First, compute the present value. Notice I said not the net present value. We're not including the initial cash flow. So cash flow 0 is 0. Cash flow second, clear. We're just valuing the future cash flow. So cash flow 1, 63,120. Cash flow 2, 70,800. Cash flow 3 is 91,080. And then you compute for net present value. We gave it timing and magnitude. Now we need risk. Interest rate is 12. Down. Compute 177. That's the present value of the future cash flows. That's your numerator in the profitability index. Divide that by the initial cost. So you'll go divide by 165,000. Now you put all of the present value of the benefit divided by the present value of the cost, which is 165,000, and you get a profitability index of 1.08 almost. Why is this advantageous? Well, it's related to NPV, and it's going to lead to an identical decision. It's a convenient way to understand and communicate your project, and it may be useful when available investment funds are limited. However, it could get you into a pinch if you have mutually exclusive projects. So the only investment decision criteria we saw that didn't really have as many flaws was NPV. So let's again talk about the things we're doing here in corporate finance. Capital structure, don't get this confused with capital budgeting. Capital structure is the mixture of debt and equity. You know, what assets should the firm buy? That relates to a capital budgeting. But capital structure is the choice of, we need money. Do we get a loan, or do we ask the owner for it? Or do we issue a bond, or do we use previously reinvested profits? That's capital structure. Capital budgeting relates to the left-hand side, your assets, and specifically your long-term assets. The process of planning and managing long-term investments, investments that last more than 1 year. So size, timing, risk of cash flows is really the essence. Timing, risk, magnitude is the key to valuation. Those are the three things. So how do you decide? Do the benefits outweigh the cost? Why should you care? Maybe it's going to be your job. If it's not your job, you're probably going to work at a company that uses these criteria. NPV and IRR are used at most firms. So even if you have an idea that spans more than 1 year, there's going to be a finance person there that is going to evaluate your idea, and this may come back. And it's nice to know a little bit about the tools that they're going to use to evaluate your idea. You may need to persuade other people in your organization to spend money on your project or your idea. And you need to understand how projects are evaluated so that you can make your case. You know, speak the language of financial analysts, know what they're trying to say, and influence them accordingly. So, you know, when we do this in practice, we consider several investment criteria. Like I said, most commonly you'll see NPV and IRR, but you may come across payback and a few others. But make sure you know how to calculate NPV and IRR, because you will see those again, whether you're a financial analyst or not. It's going to come back. Payback is used as a secondary criteria. Love this evidence from the field. Graham and Harvey went out and they surveyed 329 CFOs about cost of capital, capital budgeting, capital structure. And here's the summary. The percentage of CFOs, or chief financial officers, who always or almost always use a given technique. So more than 70% of them always or almost always use NPV and IRR. We talked about hurdle rate. What's hurdle rate? Well, that's the minimum return that we are comparing the IRR to. That's the rate we're trying to exceed when we have a IRR. The reason I taught you payback is right here. It's the fourth most common one, used still more than 50% of the time. I'm not a huge fan of using the payback period, but people like to get their money back, so they measure it. Sensitivity analysis, that's just the analysis of what happens when you change one variable to see its impact on another. So, you're just changing one variable at a time and seeing how sensitive it is to impacts the NPV. So the rest you talk about less than 50% of the time. And when we talk about chapter 10 and 11, we'll talk about sensitivity analysis. So I'll put a little summary down here for you. NPV is by far the most important decision criteria. So if someone asks you, if you get the chance to influence someone that's making a capital investment decision, encourage them to use NPV, teach them about IRR, but make the decision ultimately on NPV. So other comments from me, use these criteria to help you make decision. However, what we're doing here is pretty hard. These are just estimates. Cash flows in the future are uncertain. So don't put a whole lot of weight in here. I mean, in a world of so much uncertainty, we should at least be certain in our math. But the idea that cash flows 4 years from now is pretty ridiculous. Keep that in mind. Don't put too much faith in this. This is just one tool to help you make a decision. There's a lot of uncertainty about the future. Be able to calculate these criteria, know how to talk about them as well. That's the art part of it. Influencing people to make a decision. It's not everybody's persuaded by pure mathematics. If you are able to articulate complex scenarios in an effective manner, you're going to be a phenomenal business partner and a leader. You're going to get people to see over the hill that they can't see. You're going to be able to influence them accordingly, and they'll follow you. So I wish you all the best in this.